If you're paying attention to the housing market, then you already know. But in case you haven't been, let me tell you, interest rates are up. At the time of recording, the average rate on a 30-year fixed is 6.29%. Why? Well, to fight inflation, the Fed continues to raise rates on banks, and those higher rates get passed down to consumers. So, is this strategy working? Well, I won't weigh in on the economy as a whole, but when it comes to our real estate market, the answer seems to be yes. Let's take a look at this graph. It shows the percent of the list price people paid, on average, for homes in our area over the last few years. Anything over 100 means the buyer paid more than the seller was asking for. And importantly, this graph shows yearly averages. So the point on the line for June 2022 is the average from June 2021 to June 2022, and so on. What it shows is a trend of runaway prices in our area when mortgage rates were at their lowest, and then finally some relief as mortgage rates started to really rise. Now, you might look at the scale and think, even at their worst, 3.5% of our asking price doesn't seem too bad. But remember, these are yearly averages. If we look at monthly averages over the same period, the spikes are more extreme, going as high as 12%. And remember that these are averages. It is not hard to find examples of good houses that far exceed these averages. I had some clients who were looking at this time who routinely saw houses they were interested in go for 25, 30, and even 40% over asking price. But where does that leave us now? Sellers certainly are missing the days of extreme bidding wars, but what about buyers dealing with the high interest rates? How much worse off are the buyers now that the rates have climbed so high? It might not be as bad as you think. Let's take a look at some of the examples of monthly payments for buyers, putting down 20%. In March of this year, the average house in our area was listed for just under $884. The interest rate was just above 4, making a monthly payment of $42.88. But buyers didn't pay list price in March. The average was 12% over, so that house listed for $884 actually sold for $990, making the payment $4,800 instead of $42.88. But like I said, the good houses, the ones with updated kitchens and good floorings on quiet streets, those went over the average. Here's a prime example of one of my colleagues at Century 21 Real Estate Center that was listed for $885 but sold for $1.235. The buyer, again assuming 20% down, would have a mortgage of not $42.88 at list, not $4,800 at the average, but nearly $6,000 a month. Compare that to today, buyers are now getting homes at asking price, albeit with higher interest rates. With today's rate, purchase for asking price, the mortgage would be $52.25. Now, obviously, that's higher than the payment at asking price back when rates were low, but buyers weren't paying asking price. Looking at this real-world example, this buyer would have actually saved nearly $800 a month by waiting and paying the higher rate with the lower price. And this isn't an isolated example. We had no problem pulling example after example of houses over the last couple months that went well over asking price with a low rate that would have had cheaper payments if they were bought at asking price with today's higher rate. And the savings are significant. The average of these 12 examples I pulled is over $1,000 a month. So yes, for these buyers, waiting for rates to go up and competition to cool off would have saved them money. Something to think about when looking at the real estate market. Stay safe and thanks for watching.